Nearly 88% of contractors are overpaying on their taxes. Why? Because they don't know how to properly calculate something called the work in progress adjustment.
No more burnout, no more fear. We'll build it strong, make it clear. Not just a grind, but a dream that's true. Building a business that works for you.
Most builders I talk to are leaving money on the table, not because they don't work hard, but because the numbers on their books are lying to them. Yes, here's the kicker. Nearly 88% of contractors are overpaying on their taxes. Why? Because they don't know how to properly calculate something called the work in progress adjustment. Now, I know that sounds like boring accounting talk, but listen, this little calculation could be the difference between keeping tens of thousands of dollars in your pocket or handing it over to the IRS for no reason. In today's episode of The Builder's Edge, we're going to break down what the WIPAA adjustment really is, why so many builders are getting it wrong, and exactly how you can fix it so your profit and your taxes finally tell the truth about your business. Let me give you a real world scenario. Imagine you're a builder and let's just say you signed a contract for a $500,000 home. Make the numbers kind of easy. That's your contract value, the amount the client has agreed to pay you for the entire finished job. Now, based on your estimate, let's just say you expect that it will cost you $400,000. That's your labors, materials, subcontractors, everything to finish the job. That's your budgeted costs. Remember that. Fast forward, let's say a few months, you've already maybe poured the foundation, you've put in the foundation, framed up your structure, you paid for materials, and let's say to date you've spent $120,000. Here's the key part most builders miss. You take that actual cost to date, $120,000, and you divide it by the budgeted cost, $400,000. And that shows that you're only 30% complete on the job. Now, here's where the work in progress adjustment comes in. If the contract is worth $500,000 and you're 30% done, you've technically earned $150,000 in revenue so far. But let's say you've already billed your client for $200,000 at this stage. On paper, it looks like you're ahead of the game, but in reality, you've actually overbilled. You've overbilled by $50,000. Your 30% comes to $350,000 of your $4,000 cost. So you've overbilled that $50,000. This $50,000 is not profit, it's a liability. You'll need that money later to pay for your trades, your suppliers, and everything for when the job continues and it's done. And here's another problem. If you don't make that WIPAA adjustment, your books show that you've earned $200,000 in revenue, but you'll end up paying taxes on that extra $50,000. It's not real revenue. And it'll appear like it's actually income. And that's where builders get hurt. They're paying taxes on that money that's not even actually theirs. It's not even actual profit. And this isn't rare. The 2025 Residential Construction Report revealed that 88% of builders are overpaying on their taxes simply because they're not calculating this. They're calculating the WIPA incorrectly. So what's the fix? Run your WIPA report each month. Compare your actual cost to your budgeted cost. Figure out that percentage complete, calculate your earned revenue, and adjust your books accordingly. If your accountant isn't doing this for you, you need to either educate them or find one who understands construction. Because here's the truth, cash in the bank doesn't mean profit. When you get paid for the job, you've got all this money in the bank. You need it to pay all these expenses for that job. That doesn't mean that that's profit. And taxes on fake profits can bury a construction business. So let me share my screen with you real quick. And we will kind of, for all my visual listeners out there, we'll take a look. So, step one, you want to define these key numbers. Like we spoke about, your contract value. This is the total amount you're billing for the client for the project. It's usually the signed contract price, including any, of course, approved changes or change orders. Example, you signed this contract for this job for $50,000. Budgeted costs. This is the estimated cost of the complete entire job for everything. That's the projected 400. The actual cost. This is how much you're actually spent on the project so far. An example, you've spent 120,000, that's your percentage. Here's how you find your percent. It's the actual cost, and then you do your percentage complete, cost to date. That's where you get the 30%. Calculate earned revenue. Revenue you should recognize. Earned revenue, contract value times your percent is the completed amount, your contract value. So a complete example, 500% times 30% equals $150,000. That's what you're going to be paying your taxes on. That's your $150,000 in revenue. Compare this with your billed revenue. If you already billed $200,000, but you earned revenue is only $150,000, you're overbilled by $50,000. That becomes a liability. If you've only billed $100,000, but your earning is $150,000, you are underbilled by $50,000, and that as an asset. The difference is your WIPAA, work in progress adjustment. So to answer any confusion directly, budgeted cost equals what you expect, actual cost, what you spent, the ratios, your percentage complete, and that equals your contract value. So, builders, if you found value in today's conversation, take the next step, subscribe to the show so you never miss an episode. Share it with someone who needs this insight as well. And check out my D&D Business Systems website and get some more ideas to put into action. Remember, this isn't just a podcast, it's your platform. Your story matters, and we're here to help you amplify it. Thanks for listening, and I'll see you the next time on The Builder's Edge.